In this module, we're going to focus on taxes and tax policy, specifically focusing on taxes at the federal level. And we'll take a look at the different types of taxes and the amount of revenue raised by them, and then focus primarily on the income tax because that is, in fact, the largest source of income for the federal government. And we'll take a look at some of what we call tax expenditures or tax breaks and see how they affect the overall budget. So as you see there, our favorite thing when we do our taxes for April 15th, uh, usually on April 15th itself, if you're like me, sometimes people are smarter than that and get it done early, but it's an enormously complex system. Let's understand a little bit about this by just putting it in some perspective as to the types of taxes that we have. Both the state and the federal government can pretty much tax concurrently on different things. Historically, what we've seen is that the federal government, at least since the passage of the 16th Amendment in the early 1900s, has focused primarily on the personal income tax as its largest source of revenue. Prior to that, it was actually, interestingly enough, excise taxes on alcohol, tobacco, and various other things that formed the big bulk of the federal government's revenue. But once we passed the 16th Amendment and made the income tax uh, legal in the United States, we saw that that became the biggest source of revenue. And interestingly enough, also coincided with the growth of the federal government because it had a huge new source of revenue. At the state level, we generally see that state sales taxes were typically the largest source of revenue for most states. Now they are kind of balanced out between personal income taxes, which are become much more popular at the state level. Not all states have a sales tax. Not all states have personal income taxes, and the types of systems that they have, and graduated income and progressive versus regressive systems are all a bit different. And then finally, at the local level, in general, we've seen over the American history that the property tax has been the largest source of revenue for local governments. One thing that's becoming more acceptable and more a source of funding also has been some kind of an earned income tax credit at this level. But for our purposes in this module, we're going to focus in primarily on the personal income tax. So here are the federal revenues for fiscal year 2024. And as we take a look at them, we see that the two biggest sources of income are the individual income taxes and then payroll taxes. Individual income taxes are based on the amount of money that you make. And we have a graduated income tax system here, which means that the more you earn, the higher your tax bracket is. Payroll taxes, on the other hand, are just a certain percentage of your income that goes to the federal government. Just primarily Social Security and Medicare are the two big things. So if you take a look at your deposit slip from your employer, you will see not just federal income taxes, and if you live in Pennsylvania, state and local um, taxes, you'll also see money coming out for Social Security and Medicare. Uh, you pay half of these taxes, and your employer pays the other half. If you are you own your business, then you end up having to pay all of that. But those payroll taxes are generally considered to be regressive because everybody pays the same percentage in their income. And then finally, we have some corporate income taxes, and also I mentioned the excise taxes and duties. Uh, right now with the Trump administration and tariffs, there's an additional about $20 billion a month coming in through the use of tariffs as a source of income for the federal government. But suffice to say that our real focus needs to be here, since it's the overwhelming amount of money comes from payroll and individual taxes. All right, so who pays taxes in the United States at the federal level? So what we see is these are the averages. We'll talk about the top 1%, 5%, 10%, 25%, 50%, and the bottom 50%. And all taxpayers averaged out across the country, taxpayers pay about $14,279. Now, what you're going to see here is that the people that earn the most in this country also pay the most in taxes. So if you're in the top 1%, you pay an average of about $650,000 a year in federal income taxes. And then again, a little under $200,000 for the top 5%, and you see it gradually goes down. Now, what you'll see is the top 50% of Americans then pay almost $28,000 a year in income taxes, and the bottom 50% of Americans only pay about $667 a year in income taxes. So you say to yourself, all right, well, people that are going to be making more money are obviously going to be paying more in taxes. So, how does the system work? Well, what we see is that there are various different rates that we can take a look at, and we'll take a look at those rates a little bit more in a couple of minutes. But the effective tax rate, in other words, when people get done filing their taxes, they have all kinds of deductions and things. So if you take a look at the almost black kind of column here, what you'll see is that, as you look through here, the average tax rate in the United States for everyone is about 14.9%. And you will see that that kind of declines if we start at the top, which is the top 1%, 25.9%. If you're in the top 50%, you'll pay 16.2%. And if you're in the bottom 50%, you would average about 3.3% of your income going towards the personal income tax, right? So definitely what we would call a progressive income system, in which those people that are making more money in the system end up paying more into the system and a larger share of their income. Now, there are a substantial number of people in the United States that don't pay any taxes. And if we take a look at that, um, about 40% of all American households end up not paying any taxes, right? And as we can see here, the way the system's set up is that it is distributed in a way in which most of the people not paying income tax are people that are in the lower 40% of the American population. So, we take the lowest quintile and the second lowest quintile, and together what we see is there's about 86% of those people in those income that pay no income tax. And if we take a look at the bottom 20% of Americans, if you're in the bottom 20%, about 88.6%, roughly roughly 9 out of every 10 people in that area end up not paying any federal income tax. So, there's definitely, we hear a lot about people not paying any income tax in the wealthiest categories in the U.S. The evidence doesn't really show that. This is the most recent stuff available, but even the top 0.1%, 0% end up, paying no taxes, and the top 1%, 0% pay no taxes, and in the top 20%, 0.2% end up paying no taxes. So, for the most part, this is a system in which there's progressive income tax system in the U.S. Now, here's a video on how tax brackets work. This will be made available in your module. It's an interesting look into the way that this whole system works. But if we take a look at this, these are 2025 tax brackets. And what we see is that your income gradually, as you make more money, gets taxed at a higher rate, right? So, the first, let's just say you're married, filing jointly, the first $23,850 of your income, you pay 10% on, right? And then gradually, as you make more money, you move through the various tax breaks 10, 12, 22, 24, 32, 35, 37. And as you move through those general increments, that means that you're going to be paying more on each level of increment as you go up, right? So for those of you who are lucky enough to make $750,000 or more and marry filing jointly, if you get that much, everything over that amount, you'll be paying 37% on. And this is kind of why everybody has a different tax rate on what they pay. Now, one of the things that I mentioned is that there are these common tax deductions. As a consequence of the Tax Reform Act of 2017, something called the standard deduction was raised rather sharply to simplify some of the tax code. And what we saw was that in 2025, the first $15,000 of your income is your standard deduction if you're single, and you don't have to pay any tax on the first $30,000 of your income if you're married filing jointly, right? So, as a result of the 2017 Tax Reform Act, many people no longer itemize because the standard deduction has been raised so high. But as we can see, if if you do find yourself in a situation in which you can itemize yourself, some of the big ones are a mortgage interest on your house, your charitable contributions, taxes paid to state and local governments, although this was severely limited by the Trump administration because Democratic states tend to have higher taxes than Republicans, and they wanted to stick it to the blue states. So, what we call the SALT deduction, or the state and local tax deduction, was limited to $10,000 in the 2017 Tax Act. And ever since then, that's been under assault by blue states. People that have kids, you can deduct, you get a dependent tax deduction, as well as, some, depending on how much you make, maybe get some child care relief. And one of the big things is home offices for businesses, although this is one of those things that people like to audit quite a bit. Now, we call these tax breaks, but for those people who actually study tax policy, they're called something a little bit different, and that is a tax expenditure. Now, why would you call it a tax expenditure? Well, essentially because if you didn't have these tax breaks in place, you would be raising more revenue. So you're spending potential tax money by having these deductions in place, and that, in essence, then becomes an expenditure. Now, it's very difficult to kind of determine what this actually means. You've got two figures here from the Tax Policy Center. One is the Joint Committee on Taxation, and the other is the Office of Management and Budget. And you can see that they don't always jive with the way they calculate these figures, but it's good enough for us to understand and get some kind of handle and baseline of what this all means. The biggest tax expenditures that we have are essentially for the benefits that we receive from our employer, which are not taxed. So we have tax benefits for our employer defined contribution plans. So if you have a 403B or a 401k, and we put money into that, you do not get taxed on what your employer puts into that for you. And you are not taxed on that until you take the money out later in life. So that is a huge tax expenditure, encouraging people to save for retirement. Tax exclusion for employer-sponsored health insurance. So if you have health insurance through your company, you do not have to pay for the amount that your employer pays for your health insurance. That is not considered to be part of your taxable income, and therefore that it's a very large tax expenditure. And then we also have kind of, again, those tax benefits for defined benefit plans, which are, also related to kind of saving for retirement. There are all kinds of other things. We'll talk a bit about the earned income tax credit in a little bit, charitable contributions, credit for children. So these are the major tax expenditures. Now, lest you think that there aren't a lot of them, I took a look at the Treasury Department's uh, primer on tax expenditures, and it is 37 pages long, listing all the tax expenditures that are in the U.S. tax code. So there are all kinds of tax expenditures that are out there. Now, one of the things about the tax expenditures are that they disproportionately go to people that are wealthy. So again, let's break this down by the income tax and the payroll tax, again, which you can recall is Social Security, Medicare. Um, About half of all benefits from tax expenditures go towards the highest quintile, the highest 20% of people in the United States, and about one third of all payroll taxes, right? So, basically, those people with a higher income are able to use these tax deductions because A, they're in a job that provides these types of tax deductions. In addition to that, they're able to exceed the standard deduction, which allows them to, itemize their taxes. And as a consequence of that, people view this as being a relatively regressive system. And again, we talked about the progressive nature of this, that the more you make, the more you pay in income taxes. That side of the income tax is progressive, but the tax expenditure side of it is what we would consider to be regressive because too much money, not too much money, it depends on your opinion, but a larger disproportional amount goes towards wealthier people. Now, what's interesting here is that if we were to consider tax expenditures to actually be government spending, it would be the largest program that the federal government engages in, even larger than Social Security. So, the figures are all over the place when I'm showing you these in various years because information is hard to come by. It's not done every year by a lot of these people. But the Peterson Foundation says in 2024, tax breaks or tax expenditures cost the equivalent of $1.9 trillion. And that's compared to Social Security, which we pay $1.4 trillion a year in, right? So the biggest source of expenditures by the federal government is on tax breaks. Now, one of the final things I'd like to show you here is one of the things that's considered to be more successful within the guise of tax expenditures, and that is the earned income tax. And there's an interactive tool that you can click through here from the slides. But the earned income tax credit is essentially a tax credit that is aimed at working families and helping them to get tax relief by working. So if we take a look at this, the more you make, if you make up to about $45,000, you're eligible for most things if you have kids. And then it starts to phase out until you get up around, 56,000. This is the adjusted gross income at the bottom. So essentially, the limit on this is if you have four children, three or more children, you can get up to $8,000 a year returned back as an income tax credit when you file your taxes. So this is a way really to provide more cash, direct cash without any strings attached to it, to working class families and help subsidize their income. This has been shown to pull people out of poverty. People overwhelmingly studies have shown that this is used to help augment people's living expenses, to augment their food expenses, housing, to help them get transportation for their jobs. And it's a relatively popular tax credit for both Democrats and Republicans. For Republicans, more so because it's just a straight up benefit given to people. There's no strings attached to it. There's no social goal attached to it other than helping give families that are lower income money. About 25 million working families are currently eligible for this, with the average benefit being about $3,100 if you've got a family of four. And with this, unlike some of the other tax credits that we've seen or tax expenditures, what you'll see if you take a look at the triangle, the orange triangle there, is that this disproportionately goes to those people that need it the most, right? So about 50% of the earned income tax credit goes to those people in the bottom 50%, 40% of earnings, and very little goes to people in the top quintile. So overall, this is considered to be an example of a successful tax expenditure.